We're here at the New York City Real Estate Expo, and I'm sitting here with Sandy Klein of SGKK. And Sandy, you're going to tell us a little bit about what SGKK is all about.
Okay, Rick, thank you. Shanholt, Glassman, Klein, Kramer and Company, which was founded in 1931, has a niche specialty in real estate. We represent clients and old line family real estate companies throughout the United States since 1931 and enjoy a wide and excellent reputation in the real estate industry.
So you're a national firm?
We're a national firm, but our offices are based in the city here.
Okay. So your office is in New York, but you have clients all over the country.
Exactly.
And your niche, so-called, is the CPA or accounting help for a lot of the commercial real estate companies?
Absolutely. What we do is we have an audit department, a tax department, which we specialize in real estate, as I said. Clients who buy real estate or dispose of real estate call us. We're a proactive firm. We encourage our clients to have a proactive relationship with us, as we can best help our clients before a transaction has occurred to help structure the best opportunity for a purchase or a sale for a client. We do a lot of 1031 transactions. We do a lot of tax planning. And as real estate is, high net worth people have trust and estate needs that we get into that tax planning issues as well.
So you have to be up to date on all these new tax laws, which I'm sure change yearly.
Absolutely. They get more and more complicated. I just saw the debates last night about tax simplifications, but they've been talking about that for the last 25 years. So
I don't think those two words will ever go together, simplified and taxes. They just don't work together.
Exactly. There are many different competing forces in and out of Washington, and a lot of lobbyists, but that's the tax code we have, and it is complicated, and we don't have any clients that don't have a need for our type of services.
Now, in a transaction, and some of these are major transactions, I'm sure that you handle, that there's a lot of dollars exchanged. Now, if someone has to turn that money over into some other type of investment or another type of property, what if they just took the money and said, you know what, I'm retiring, I don't want to be in the real estate game anymore?
Clients do that, and they cash out, and they have typically a large tax bill to pay. But that's okay, because if it's structured correctly, they would get lower capital gain tax rates that prevail at the time. But most of our clients are not in that position. Most of our clients would rather do a 1031 tax-deferred transaction where they roll over the proceeds into another like-kind property, enabling them to defer their tax on this property. Ultimately, they have to deal with the taxes in the future, but it's very complicated, but it's very worthwhile to enter into such a transaction.
But now on a 1031 transaction, doesn't that have to be of equal value or higher?
Exactly. You have to be careful with the amount of equity proceeds, the amount of debt coverage on the new property. You can use more than one property. You can use multiple properties to accomplish a complete tax deferral. And it needs to be structured very carefully and methodically in order to achieve full success in it.
What if someone did have a major transaction like that, and they chose not so much a real estate transaction, but something on the idea of a corporation, that
a business,
like a manufacturing company, something like that?
Right. Well, real estate, in order to do a tax-deferred exchange, you need to reinvest the proceeds in what the IRS calls like-kind property. So even within the real estate, what we know as real estate is not necessarily qualifying property for like-kind property. It has to be an investment or trade or business type property, not property that you're going to develop for building homes or condominium developments. So certainly going into a business as a means with which to invest such capital is not going to work. In fact, Rick, if you sell your real estate and try to buy a partnership interest that owns real estate, even a partnership interest in real estate does not qualify as like-kind property. It needs specifically to be titled as real estate.
So it has to be real estate So you basically have you're a sole owner.
You have to be it's a great point. You have to be a sole owner. There are ways with which one can come out of a partnership structure where not every partner wants to do a 1031. And so we drop the asset into what's called a TIC, or what's known as a tenant in common. And tenant in common, the definition is an undivided interest in real estate. And that does qualify as like-kind property. So what you do is the partners that want to cash out, as you said before, they would sell their TIC interest for cash. And those partners that want to roll over their profits and do a tax-deferred exchange can do that with their TIC interest. So there are ways to do, and there are other ways to accomplish that, but we'd have to sit down and tailor the transaction for each client.
Now, what about trusts? I know a lot of companies used to. I'm not sure if they still do it. They put the properties in a trust, and that it's all family members that are owners of the trust.
Trusts are great vehicles for estate planning. You can gift or sell property into what's called as an intentionally defective grantor trust, or called a grantor trust, whereas the grantor, which is, let's say, the parents level, they own the real estate, they convey the property to this trust. The beneficiaries of the trust are the children typically. They have an independent trustee. The parents get the proceeds of the cash flow typically, because when they sold it for a note. And the note has to be satisfied by the trust to the parents. Ultimately, when the note is paid off, all the cash flow goes to the trust and hence to the beneficiaries. The beauty of this transaction, to structure it properly, is that you do an estate freeze. So this asset is removed from the parents' level estate. It's now owned by the trust. When the parents pass on, the trust owns the property. It's not part of the parents' estate anymore. And it's a wonderful situation. And the kids, they've just passed on valuable real estate at a lower value. And there are certain discounts that you can get and gifting that can be intertwined with such a transaction.
So, because in a situation like that, especially in New England, you have a lot of property owners that have owned property probably 50, 60, maybe 80 years.
And have no tax basis, so zero tax basis.
Exactly. And now family, they're going to take over these properties. And, that's where I'm kind of curious. What tax repercussions are going to come out of that? Because obviously the elders of the family are taking the money for retirement. That's their retirement fund.
Sure. So the beauty again is that if you sell it for a note, the note you can peg any interest rate to it, any reasonable interest rate. The note gets paid off. Interest gets paid periodically. So the cash flow that the property generates is taken by the trust. The trust in turn is paid down the note that is owed to the parents. So the parents have that cash flow. Meanwhile, the property is now owned by the trust. When the parents pass on, again, the property is now owned by the trust. It's not part of the estate. The balance of any note that's not paid off is an asset of the estate. So it's a perfect situation. Now, people are talking about the elimination in Washington of the use of discounting. So the discounting feature is that when you have a minority interest, lack of marketability, these aspects typically call for anywhere between, let's say, a 20 to 35, 40% discount off the value, an appraised value. And so that's another further benefit that the grantor can achieve in lowering his total estate planning. Now, keep in mind that because it's a grantor trust, for income tax purposes, nothing has happened. It's not recognized for income tax purposes. It's only recognized for estate and gift purposes. It's considered a completed gift. So it accomplishes what you want to do for estate. For income tax purposes, the parent level continues to pick up the income. Put aside the cash flow, the taxable income is still picked up on the parent's level tax return. So, and the parents pay tax. That is a further estate planning because you are using funds that would otherwise go into an estate of the parents and not paying the tax that the kids should otherwise pay.
Right, but they're using that for retirement
Exactly.
purposes. Now, this is sort of off course. Now, you're running for president. Let's say you're running for president and you own a lot of real estate. What happens?
I would love to do that. After seeing the debates last night, I'm ready to run.
But, the Donald, he's got all this property,
right?
All this real estate asset. And I thought when you become president, you're supposed to turn over all your assets. Isn't that the case?
I don't know. It sounds good, or at least put them into a trust.
Yeah.
I think we had a mayor of New York for 12 years, running one of the also not only the largest city but one of their largest companies, and I think he had a board who took care of Bloomberg. But I always viewed it as pretty odd that one of the largest, most successful companies.
Because I thought you were supposed to turn over a lot of your assets into some kind of a trust or something that it couldn't be. You wouldn't have that ability to run that company.
I would say let's leave it to Donald Trump, who can persuade everyone in America that it's no problem. I can still run my real estate empire and be president of the United States. He's a very persuasive guy.
That's right. Hey, maybe that's what we need.
Absolutely.
I'm not endorsing him, but well, thank you. There's Sandy Klein of SGKK, and if you need any tax information, Sandy would be more than happy. How would they get a hold of you if they wanted information?
Sure, we can call me at 212-644-9000. We're on Midtown Manhattan at 575 Lexington Avenue. That's at 51st Street. And again, we have over 60 people. We're a boutique CPA firm specializing in real estate, planning transactions, and we're very proactive and have a high level of relationships with all our clients.
And Sandy, what's the website for SGKK?
It's Shanholt.com.
Oh, okay. That's easy. I thought with all the names it was going to be this long website.
It's very simple. You can pick us up at Shanholt.com, or you can Google Sandy Klein CPA. It'll bring you right to that website.
Fantastic. Thank you, Sandy.
Rick, thank you very much.